Discretionary spending lifts US retail sales. What does it mean for the Fed? Welcome to Market Insight. I'm David Pollard. US retail sales increased solidly in September, supporting the view, perhaps, that the economy maintained a strong growth pace in the third quarter. Sales were up 0.4%, 0.1% above forecasts, and a so-called control group of core sales jumped 0.7%. Well, I'm joined now by James Knightley, Chief International Economist at ING. Welcome, James. So lower gasoline prices may have given consumers more money to spend at restaurants and bars. Is that what we're seeing in these numbers?
Well, I think we're seeing a lot of things. Actually, the key story is the remarkable resilience that the US consumer continues to have, despite the concerns about the jobs market cooling, despite the pressures of savings being exhausted and high borrowing costs. They just keep spending and spending. And it does look as though the economy is still on track to record a second consecutive 3% growth rate in this current quarter.
But to what extent do these numbers hide the fact that disproportionately high spending by richer households is offsetting weaker spending by low-income groups?
Yeah, I think that's a really important story because we know that the top 20% of households in America spend, in dollar terms, more than the entirety of the bottom 60% of households by income. And if you're in the top 20%, pretty much everything that could go right is going right. High incomes, by definition. And of course, you've seen your housing wealth soar, your equity market wealth soar, and high interest rates have actually been benefiting you. You've probably been locked in at a low mortgage rate for the next 30 years. Whereas you can put your cash in money market funds yielding 5%. So those households are doing very, very well. But there are more pressures for lower income households where inflation is more of a constraint. Renting is a bigger issue. They don't have the wealth that has soared. And of course, high interest rates do hurt them. And I think that divergence in the household performance is a key story to where we go from here. How long can those high-income households continue to offset intensifying pain and intensifying weakness in the lower-income households?
And what's your take on the day's other data? Manufacturing looked weak, down 0.4% in September. Jobless claims, though, they were lower than expected. Still pointing, though, to a weaker jobs market, according to your notes.
Yeah, I think that's right. I think we do have to acknowledge that the recent hurricanes have impacted all of the data flow. It may well be that it's sort of distorted spending patterns for the households, but I think it's certainly had an impact in manufacturing that we saw was down today. Likewise, the Boeing strike, that will have certainly impacted aircraft production, but also supply chains that tie to Boeing will also have been hurt by that. So I don't think it's a real surprise. Hopefully, we will get a recovery over the next month or two from both of those sectors. But yes, I think the jobs market is the clear story that we need to really be focusing on. Hiring does appear to be slowing, and jobless claims do seem to be on the rise. So that suggests, that the jobs market slowdown is intensifying. And if that's the case, then that will put more and more pressure on that bottom 60% of households that I've already mentioned. If those start to fear the risk of joblessness coming on the rise, then that can be much more of a headwind for economic activity that can be felt more broadly in the economy as well.
So all in all, it appears to be a bit of a mixed picture for the Fed, which itself will be looking at the Beige Book next week, which has emerged as a key telltale for policymakers.
Yeah, no, I agree entirely. I think, the inflation story is looking better behaved. So the Fed can pivot and put more emphasis on its second mandate, which is maximum employment. So that data is critical. But also, I think one of the key reasons why the Fed cut rates by 50 basis points in September was evident weakness in the Beige Book, this anecdotal survey where they go around and speak to trusted contacts about what they're feeling on the US economy. And that last time around was very subdued. And if we get a repeat of that, coupled with another softish jobs figure, then I think we certainly will be looking at a further rate cut in November, probably 25 basis points, with a further 25 basis point cut in December.
Now, of course, we're also in the middle of Q3 earnings season. What can we read across from the latest earnings reports into the economy, or indeed, what impact might the economic outlook have on future earnings growth?
Yeah, I think, looking at the analysts' expectations, they weren't as high as they were for the second quarter, which, of course, was met. And I think so far, we've seen the companies coming in a little bit above the consensus earnings expectations. So that, again, suggests that the economy is performing pretty well, pretty robustly, despite the headwinds that it faces. But I think it is important to point out that the equity market is looking to the future at all times, and the Fed is cutting rates for a reason. It feels that there is a cooling coming through, and those earnings estimates in coming quarters maybe even softer than what we've seen in the third quarter. So I think the pressure is going to be much more telling for US corporates as we move through the fourth quarter and into next year. Those headwinds could become more of an issue for their earnings story.
Okay, James, it's been great to hear your thoughts. James Knightley, Chief International Economist at ING, many thanks for being with us today. That is your Market Insight. You can watch more videos on Reuters.com.